we underestimated how high prices would go. We wouldn't be surprised to see the prices pull back now. June, July, August is seasonally weak period for investment demand and for fabrication demand, which tends to be reflected in weaker gold prices and silver prices. Not massively weaker, but some consolidation, like 5 to 10% decline. We wouldn't be surprised to see a little bit of a pullback. Some profit taking has already set in. Copper's a special story, but we want to talk about gold and silver. But then we think that prices go higher in the final 4 months of this year, probably into 2025.
JeffChristian, a well-known analyst and advisor in the precious metals and commodities markets, predicts that there are some seasonal months for the precious metals, and prices will drop in the short term but remain extremely bullish in the longer term. However, gold prices are volatile, and recent economic conditions and geopolitical crises may further increase this volatility. These price targets come with short-term corrections. The breakout of $2,075 has set an initial price target in the $3,000 region, as indicated by the ascending broadening wedge formation from 2017. This pattern suggests that while gold may show volatility, the trend remains bullish. Since the gold market broke the pivotal level of $2,075 in March 2024, prices continued to rally higher in April 2024, reaching record highs. However, May and June are typical months for seasonal correction. The chart indicates that June historically has only 25% positive candles, meaning that the month ends negatively 75% of the time, based on the last 5 years of data. In contrast, July has shown 75% positive candles, suggesting a substantial likelihood of positive performance within the month. This pattern implies that the gold market may form a bottom in June, setting the stage for a robust rally in July. We will now present clips from Jeff's discussion with Kai Hoffman. But before we do, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos on gold, silver, and other metals and commodities. Thanks for the support, and enjoy the video.
We have been saying for several years that we thought gold and silver and other commodities would rise very sharply into 2024 and into 2025. And our expectations had been that we might see a kind of relatively quiet, first half of 2024 and then heating up in the second half. And we had silver at $32 and higher, and gold at $24 and higher on an intraday basis in the second half of this year. So we're at those prices in the first half of the year. Our analysis is this the peak as we thought it would be in terms of levels? Did we underestimate how high prices would go when things get worse in the second half of 2024? Short-term and long-term issues, and the long-term issue is that gold at $2,400, and the all-in sustaining costs are probably averaging about $1,500. So you have this enormous profit margin on average, and a lot of that average is skewed to just a few companies. But the reality is that gold and silver mining is very profitable at these levels. So if the prices were to stabilize at these levels, and we don't see it stabilizing at 2,400, but we see gold staying above 1,800, 2,000 on the long run, and we see silver staying above $26, $28 in the long run, and even at $28 an ounce, there's a tremendous amount of mine production that will be developed and come back on stream over the next 5 to 10 years, if the prices stabilize at that level. On a short-term basis, mine production can only do so much in terms of fast response. What you typically have historically seen is scrap recovery, where you'll see people selling their jewelry and their silverware and their and silver objects and stuff, and then that gets refined into bullion. And that can back up the refineries. But I haven't heard stories of a lot of that selling going on yet. Gold price and silver price are meaningless to the U.S. government and the U.S. economy. So gold at $2,000, gold at $2,400 has no negative effect on the U.S. economy per se. or the U.S. government's financial position. Now, the U.S. government has 261 ounces of gold, 261 million ounces of gold. They actually value that at like $42 an ounce on their books, but they know full well what it's actually worth. And everybody who buys treasuries knows what it's worth. So, it's there. And so, a higher gold price is actually positive for the treasury, because they don't own foreign exchange. They own gold. And then silver is relatively meaningless. Yeah.
China's economy is in a funk, and people are rushing out to buy gold as a safe haven asset to hedge against economic uncertainties, sending precious metal prices to record highs. According to official data released Tuesday, the country's central bank has also gotten into the act, adding 60,000 troy ounces of gold to its stash in April. It marked the 18th month the People's Bank of China added to its gold reserves. Other central banks are also buying gold. The World Gold Council wrote in a report last week that China, Turkey, and India were among the big buyers. Accounting for almost a quarter of annual gold demand in both those years, many have attributed central banks' ongoing voracious appetite for gold as a key driver of its recent performance in the face of seemingly challenging conditions, namely higher yields and U.S. dollar strength, the Council wrote. The world's central banks bought 290 tons of gold in the first quarter of this year, the strongest start to any year on record, the WGC said. Not only is the long-standing trend in central bank gold buying firmly intact, it also continues to be dominated by banks from emerging markets, the WGC added. Jeff argues that people often wonder who's buying gold, and the answer is everyone. He says central bank buying is not the primary driver of higher gold prices. Let's get back to the interview.
Some combination of economic, financial, and political concerns. And we're already seeing that. There's this tremendous drive to reduce risk in one's portfolio that's worldwide. People keep saying, who's buying the gold? And the answer is everyone. It's not central bank. Central bank buying is not the major driver in higher gold prices right now. It's really a very generalized move to reduce financial risk and political risk and move away from more risky things into gold and, believe it or not, U.S. Treasuries. I mean, one of the things that people keep saying that's not true is that people around the world are dumping treasuries. People around the world have bought a record number of treasuries. Treasury purchases holdings, offshore treasury purchases, holdings rose 10.5% last year to a record $8 trillion. People are racing to reduce risk, and that means dollars, treasuries, gold, silver. And that's what's really going on. And now, so what are the risks? Yes, we think that there's still a recession. I'm on record as saying that my definition of a soft landing is a prolongation of the expansion before the next recession. We are seeing pockets of weakness that are getting stronger in the United States economy and in the European economy, in Japan and the UK. China obviously has had a lot of issues. It continues to have issues, although last week's move in the real estate market by the central government really a positive move forward. But China has a lot of other issues. The war in Russia's invasion of Ukraine continues. The war in the Middle East continues. There are a lot of political uncertainties. And one of the themes that we've had for the last 12 months is that in 2024, political risks would probably be much more important than they historically and typically are. And they might even supersede economic and financial risks. But we're seeing financial market instabilities. We're seeing economic weakness grow. We're seeing persistent inflation in a number of countries and a number of segments of economies. So there's a lot of risk out there, and you've got investors saying, I've got to protect myself from this. And that has been pushing gold and silver prices higher. And, we maybe take a pause for the holidays, but we'll be back. One of the risks that you will have is publicly traded ETFs have daily reports. This is how much gold was bought and sold on a net basis each day. And people will take that as a surrogate for investment demand for physical gold. It won't be, because the investors in ETFs are different people from people who buy physical gold. And physical gold purchases are secret. You've got to be someone like CPM Group to suss that out. That's all important background, because over the last 3.5 years, you've seen investors buy more physical gold in the physical market, even as they've been reducing their gold holdings in ETFs. So gold holdings in ETFs fell 21, 22, 23.
Just until recently, yeah.
Into and through March, they were falling, right? And it was only in the second half of March when ETF purchases turned positive and you started seeing holdings rise.
What do you think is the price prediction of gold and silver? Do you agree with JeffChristian's forecasts about the shorter and longer-term seasonal months? Please share your thoughts with us in the comment section below. For more videos like this, ensure you subscribe to the channel, turn on post notifications, and check out our other videos. Thanks for watching.